So thank you all for attending today's meeting. Let me share my screen really quickly because I got a little slideshow on here. So I promise not to get too political with this. As just reporting the news, and how it all affects us in the real estate market. So I wanted to talk about Trump and the Fed. So what it actually means, for mortgage rates. So what we're going to end up doing here, let me go ahead and just mute everybody to make sure we're all set. Okay, perfect. So Trump and the Fed, what's going on, what it means for mortgage rates, and for the real estate market as a whole. So let's start with what's going on. As I'm sure, everybody's probably aware of, they've seen things on Twitter or Facebook or whatever about, how Trump is really putting a lot of pressure right now on Jerome Powell, who is the current Fed chair, to lower interest rates, like from the actual Fed funds rate. And so, number one, Jerome Powell doesn't actually solely control, I should say, where mortgage rates are. He's just the current Fed chair. So while he does have, he's basically the one that controls the Fed itself, but he's not making every single decision. There is multiple people that make these decisions when it comes to things like cutting interest rates or even raising interest rates. So Trump is putting a lot of pressure on Jerome Powell right now. The Fed to cut their rate to 1%, and currently it's hovering right around 4.25%. Now Powell's term does end in May of 2026, so there is a good chance that if instead of Trump actually firing Jerome Powell, maybe Jerome Powell resigns with a few months left in his term. Or he just doesn't, get appointed Fed chair again, at the end of his term here in May of 2026. Now, it is important to know that this is not the first time that we've seen a president put a lot of pressure on a Fed chair. So if you look, actually, I had this pulled up. Nixon, I think, that was putting a lot of pressure on the current Fed chair at the time. Let me pull up the notes here. Yeah, he was pressuring Fed Chair Arthur Burns to keep interest rates low ahead of the 1972 election. So historically, we have seen things like this happen before. While it's not necessarily, super common, it is not unprecedented. So to definitely keep that in mind when you're thinking of, oh, is this the end of America, right? As everybody seems to do nowadays. There is historical, precedent for this type of behavior. Now, if the Fed actually does cave, so what this would mean for you as the consumer or as a real estate professional, it could equal inflation fears, which would allow mortgage rates to actually spike and move up. So, if the markets deem that, the Fed's cutting interest rates because of disapproval from the current administration and not because of, them thinking that inflation has actually moved lower and that it's time for us to, spark economic growth before we see a giant recession. Again, that could cause future concerns of inflation down the road, which then would get priced into mortgage rates and actually cause mortgage rates to move higher. And especially if Powell's pushed out altogether, then you could see some more widespread panic in the market because now the Federal Reserve is no longer independent of the U.S. government. You can see if there's a lot of ways that the U.S. government could influence the Fed, whether it's Donald Trump or future presidents is what they're going to be thinking of. You could see higher Treasury yields because now the U.S. economy and the U.S. Treasury is deemed as a more of a riskier asset class because of that separation being removed and that independence being removed from the Federal Reserve. It is also important to note that mortgage rates don't always follow the Federal Reserve rate. So just because the Fed cuts their interest rates does not mean that mortgage rates are going to fall because they trade independently. The Federal Reserve, their interest rate, it's more tied to things like credit cards, home equity lines of credit, car notes, things of that nature. Whereas, obviously mortgage rates are tied to, what the actual underlying asset is, performing at. So just some things to look into there as well. Now, rate volatility does allow for opportunity if you are prepared. So if you are, a real estate agent on this call, or you're, just putting more effort and energy into gaining a lot more knowledge, you're going to have massive opportunities, regardless of where interest rates are at, just based on the knowledge that you're, giving yourself, and, being prepared for, those times of chaos. Whether it's, low interest rates like we saw in 2020, or even higher interest rates like we've seen for the last couple of years. The market always shifts. People always need a real estate professional to some capacity. And when there's massive confusion and massive volatility, that's actually where I've personally done the most amount of business, is just being that, light that shines through, all the chaos, and then gives people clarity to work, and get their moves done. So this is how I would message to your clients while all this confusion is happening with the Federal Reserve and the U.S. government, clashing right now over policies on interest rates. First thing I would tell my clients is that a big drop in interest rates, they're unlikely unless some black swan event, or crisis hits, right? So what I don't want to do is, I'm not giving my clients a false sense of hope that rates are going to fall to 4%, next year, right? That's, I don't know, it could happen, but I'm not banking on that. I'm currently just expecting rates to stay where they're at for the next, 1 to 2 years. That's probably, they're probably going to move lower over the next, 2 years. But it just, in my head, I'm already preparing for that they're not going to. Because then, not only does it allow me to keep working and being able to do loans today, and not, think about the challenge ahead of me right now, as opposed to prepping for, some event that might not even happen. It also gives me the confidence when I'm talking to my clients that I'm not setting them up to say, oh, well, I'm just going to wait for interest rates to fall, because we don't know that that's going to happen at all. And, if they're waiting for that 4% window, they may miss the opportunity to buy the home that they actually want. And so it's just really important to keep your clients focused on things like payment, cash to close, and they're like those two things, instead of focusing on things like interest rate, price of the home, etc. While interest rate and the price are, important and do tie into the payment and the cash to close, the payment and the cash to close are really the things that we can actually control right now. And so that's what I'm choosing to focus on with my clients. I'll tell them, hey, we'll set up that rate alert for you to do a refinance, when interest rates move lower, but we're not banking on that to be, a massive opportunity for them in the next, until we're 2 to 3 years down the line. And again, confidence wins the business in this market, not speculation. So by you having these honest conversations with your clients, telling them, I don't expect rates to drop significantly, until we see some kind of a crisis, or, possibly, after May of 2026, it just gives them, more real information that they know by hearing it from you that it's true, because, you're speaking with confidence. And it's going to allow them to, be able to set their minds at ease, focus on the task at hand, and then actually work with you and close on a home as a result of that. So final note is, be the voice of reason, not the headline chaser. So I know a lot of loan officers and real estate agents, they like to post as soon as something happens, they're posting some, thing about, oh, rates are going to drop this date or whatever it is. And there's just no substance behind that. And it's really easy for you to get discredited, doing things like that and losing your credibility, really. So be the voice of reason, not a headline chaser. Now we're going to get into a local spotlight. We're going to do Merrillville, Indiana. I chose this one because, I don't know, it's just like the most popular city, I feel like, in Northwest Indiana right now. And so why it's your hidden gold mine for first-time home buyers. You could easily throw Hobart into this as well, along with a few other, cities that are really first-time home buyer friendly. And if you specifically as a real estate agent watching this have a city you want me to run a report like this on, feel free to shoot me an email or a DM. I can get that over to you, within the 24 hours, be able to have this information. So when we're looking at, this, it's called a real estate report card. I send this to my clients when, I can tell that they're not really super, like they're qualified for a home and they want to go look at homes, but they're not pulling the trigger on anything, right? A lot of times the hesitation that they have is just due to the market. They don't know what's going to happen with that home value. They think it's going to fall, or they think that there's going to be, you know, um, they're better off renting or whatever it is. Whatever the doubt is in their mind about the real estate market, this is what I use to help them see the numbers and actually overcome that. So if you look here, let's see, we've got the median household income is 71,000, national average is 80,000, so it's not that far off. And this is Lake County as a whole. Your affordability index is 146. At 100%, the household earning the median income can afford the median home price with 20% down. So what is our median home price? Right now it appears to be $274,000. And that is across all of Lake County. If we're singling out Merrillville, it would be slightly below that. Over the last 5 years, Lake County has seen an annual return of 6.2%, on their home value. Over the last 10 years, it's been 5.6%. Over the last 63 years, it's been 3.47%. So we'll just round it to 3.5%. The national average is between 2.5% and 3% appreciation annually. So as you can see, Lake County is actually, overachieving on that over the last 63 years. So taking a 2.9% average, which is less than our 63-year average and also less than the national average, if you hold this home for 5 years, you'll gain roughly 14.5%. Your home will go from being worth $274,000 to $314,000. So that's a huge increase. It's about, what is that, 40 grand in appreciation over 5 years. So you're making $8,000 a year roughly. That math sounds right. So $8,000 a year roughly, cash on cash return, and that money's tax free. We all know that if you live in the home for 2 out of the last 5 years and you go to sell it, it's tax free up to, I think it's $250,000 for single filers and $500,000 for joint filers. And that would be off the gain. So if you bought it for $275, and you sold it for $500, you're still in that window. You still have $25,000 left that you could have made, on appreciation without paying any capital gains on that. So now homes that are being built in Lake County, 1,012 homes are being built per year. And so let's see, what are we looking at here? Currently we've got 145,000 renters. We've got 36,600 renters who can actually afford to purchase a home. And we have a 71% homeownership rate at 360,000. So what this means is, before we even factor in anybody who's moving across the border to come to Lake County, Indiana, you've got 37,000 roughly people that can purchase homes, and you only are building 1,000 homes a year. So you're going to see strong appreciation, in my opinion, over the next 5 to 10 years because there's still a high demand in that market. And we've got active listings. Over the last 5 days, we've had 138 listings hit the market. And I don't know if they give us a total here of current listings right now. But that being said, like, we all know that there's a high demand for homes in Lake County. So that appreciation number, while it is kind of crazy, like thinking about my particular home that I have in Lake County, thinking, okay, this home's gonna be worth $500,000 in 6 years. And, it very well could be, just based off the demand that we're seeing in the market. So again, if you want a graphic like this for, a particular zip code that you sell real estate in, please let me know. I'm more than happy to put this together for you. And so, your edge in this market right now is using data to win buyer trust. So what I was just showing you here, stuff like that, where you show clients the actual details of things and the reports. A lot of the analytical clients that are on the edge, of purchasing a home or renting, they're going to appreciate that. You're not going to win every single, client. Not every single one of them is going to go into a home right away, but they're going to respect you and they're going to know that you know what you're talking about. So even if they don't buy today, they'll likely come back to you and purchase when they're ready. And then sometimes, what I've realized over my career is people don't really care about the mortgage. They care about the house, right? And so while, they're looking at these different options, they just need, if they like the house that they're putting an offer in on, they just want to have a reason to justify the purchase. That graphic gives them a reason to justify the purchase. So yeah, use that as you will as well. One thing I do is pitch affordability, not just interest rates. And then you can also plug into our first-time homebuyer webinar and co-branded tools. So we do a first-time homebuyer webinar every month. We're going to kick this off in August. And so any client that comes into that first-time homebuyer webinar is going to automatically get a coupon with, $500 off of their closing costs when they purchase a home and use us as the mortgage lender. So we'll be able to give them that discount. And then if they bring a friend, we'll give that friend, $500 off as well. And we'll give the, person that brings them in an additional, I think like $250 off. So we're still hammering out the pricing and stuff on that, but we're basically incentivizing your clients to help refer you more business just by working with us, is essentially the goal for that. So like I said before, smart agents, they sell outcomes, not interest rates. So again, make sure we're focusing on, the things that we can control versus what we can't. Now, loan scenario spotlight. This is actually something that I've really enjoyed utilizing from, the loan option standpoint. So it's the buy before you sell, powered by Flyhomes. So the problem is sellers want to purchase a home, but they're stuck waiting because they have a sales contingency on their house, which weakens their offer. Timing's always messy because they don't have their home under contract yet, or they get their home under contract, now they're rushing to find a new property. And it's just, messy and stressful. And there's never really been a clear solution until, Flyhomes came out about a year and a half ago. So we have a Flyhomes bridge product, and it gives your sellers leverage. So you can buy that next home first and then sell your existing home later without a sales contingency. So you've got cash-backed offer strength, competitive timelines. They handle the details, so your clients just have to move, and it feels like a cash offer. So essentially how it works, there's 3 different portions of it. You can use any 3, or you can use all 3 together. So I'll give you a few instances of how I've actually done this with a client, with multiple different clients. So first client I used this with, he was purchasing a condo in Merrillville, moving from a home in Crown Point. They're downsizing, kids are out of the house. You guys know how that all works. So we couldn't use his wife on the application because there was an issue with some credit repayment that she had, and it just wouldn't go, conventional for us on that condo. So what we ended up doing was using this cash offer program to put a offer together on his departing residence, which then excluded it from his loan application. He was able to purchase the home with 5% down. Once his home sold, he then took the equity, put some down on his property, got it down to I think an 80 or 90% loan to value, and then paid off the rest of his debt with the proceeds of the home. So that, just using a cash offer, I don't know, I think they did a price increase recently, but from what I was told the last time, it was $2,500 for the cash offer, which allows us to remove that sale contingency from, that client's new offer. Second option that you have is utilizing a bridge loan. So you use the cash offer, plus you can pull out equity from the home, and you can use that as your down payment on the next property. And then once your home sells, you then go ahead and put that money towards the rest of your down payment, paying off debt, whatever you want to do. The third option is a cash offer program. So your client can actually make a cash offer on a property, close in 15 days or less, and then they refinance that loan into a more of a long-term loan once they get their departing residence sold. So you can do you have to do the cash offer if you're going to do any of the other two programs. But you can do all three simultaneously, or you can do one or two, of those programs respectively. So I've used all three. They're great, super easy to get done, and it gives your sellers a lot of confidence and ability when they're purchasing a home. So how to talk about it? If you know anyone who wants to move but feels stuck, right? That's like the first trigger that you want to have. If you have a client that wants to move, they feel stuck in their home, instantly think about this program. And then you can say, hey, let me introduce you to a lender who's solving this every single week. That would obviously be me. And then you can ask for co-branded landing pages, flyers, or even a 15-minute explanation. Like I can jump on a call with them and walk them through how this works. But this program is your deal closer, especially for clients that purchased homes that they could get, not the homes that they wanted over the last couple of years, when the market was a lot more difficult to navigate. So plug into what's working. If you want slides, flyers, or co-marketing support, if you want us to host a renter or a move-up home buyer workshop, or if you have a client that you think might be able to qualify for that Flyhomes program today, you guys have my info. Drop me a DM, shoot me an email, or give me a call. I'm more than happy to help out in any way that I can to get you guys moved to the next step with your clients, be able to really help you move the needle in your business. So are there any questions that we have on any of the material that we covered today? And I did disable microphones and cameras, so it looks like there's a Q&A. The Q&A spot should be working here. Let's see if we can get this. Am I licensed in Atlanta? I am. So I'm licensed in the whole state of Georgia, but yes, Atlanta, I've done a few deals in there. I am licensed in, so I'll apply back to this. Licensed in Indiana, Illinois, Michigan, Florida, Tennessee, Georgia, and Ohio. I think that's it, because I think I was licensed in Minnesota, but I ended up letting that one lapse. So I am licensed in these states here. Yep, Indiana, Illinois, Michigan, Florida, Tennessee, Georgia, Ohio. So anything you guys need in any of those states, let me know. And if you have a client that is outside of those states, also let me know, because I have access to state licenses in every state except for Hawaii and New York, through Leader One. So we've got other people that we can still move the deal to and be able to work that for you. Let's see. For Flyhomes, does the buyer need a certain credit score? Yes, they do. So typically that's going to be everything with Flyhomes is going to be ran off of a conventional loan program or loan product, because that's the guideline that you have with Flyhomes, is they're going off of conventional guidelines. FHA and VA guidelines and USDA guidelines won't allow you to exclude a departing residence, unless it's been sold, right? So when you have the contract on it and there's no contingencies, that's where you have Fannie and Freddie allow you to actually now exclude the trailing, mortgage, taxes, and insurance from your debt to income ratio. So I would say it depends on their down payment and what their credit score looks like and their credit history. I would imagine as low as a 670 with 10 to 20% down and massive reserves. A lot of times, if you've got a client that's in this higher 600s, if they have the ability to put down 10%, maybe using a bridge loan, with the cash offer. So they get the cash offer and instant equity, and then maybe they have a retirement account that's got, $200,000 in it. Like we can use that for the reserves. I would definitely think that that would be something that would get qualified for sure. Okay, perfect. Well, thank you all for coming out to this meeting here. I really appreciate it. We'll be posting this, online shortly. And yeah, if you have any questions about, Flyhomes or Atlanta clients, please hit me up and I'm more than happy to take great care of you. Thanks. Make it a great day.